Okay, guys, good evening once again. We're going to discuss cash flows. Okay, and you're aware that I like using T accounts, but just stick to what you learned in class and what maybe you may prefer. Shall stick to what you learned in class, which is ideally it's T accounts, but they're not T accounts. They're indirect. It's the theory way of saying it's a T account. If you have opening balance, then anything that increases the opening balance, we add it. Then anything that reduces the opening balance, we deduct it. That's the whole way. That's the whole thing. Okay, so saying something. Okay, so I'm going to use let me see if I can get your document. Because probably an Excel, I mean with the PDF, can't edit it. Anyway, let's use an Excel. Okay, so with cash flows, I will just give you a brief on what they really look out for, and as you do what you're looking at. Okay, so cash flows are basically inflows and outflows. They're interested in showing us, show us the movement of money, what they call in cash. They want to know, okay, this movement during the financial year. It also looks at 12 months period. Okay, so ensure they're interested in inflows. Okay, inflows. Let's say the receipt of money or funds or cash. That money has come in, that is inflows. Then outflows, we look at payment, or you can say money spent. Money spent. Those are cash flows. Okay, however, we are interested in the activities, or the three activities, the three main business activities that bring about all this. So there are three. You have operating activity. You have operating activities, and operating activities I've told you before that here you look at P&L, profit or loss statement items, okay, but they're interested in items, but they're interested in cash flows. Okay, cash flow items. Money, you spent money on it. That you spent money on it. Okay, that's why we end up removing things like depreciation. You don't want them to be part of our money from cash flow activities because they're not cash flows. Gain on disposal, profit on disposal. Sorry, going to say loss on disposal. Yeah, increase in provision for bad debts. Okay, bad debts written off. These are not cash flows. Someone didn't spend money on them. That's why we usually adjust for them. Okay. Then you have investing activities. Investing activities, basically, every time you talk about investing activities, you're looking at long-term assets. That's the whole point. Long-term assets, likes of furniture, fittings, okay, buildings, long-term assets. That's investing. Okay, long-term investments. If you invest in a project or company, okay, long-term assets. You're looking at, get the whole point. Then financing. Financing activities, basically what helps us get money. Where do we pick our funds from? Where do we get cash from? Okay, so you would say cash or you would say capital, but ideally is, if I need money, where can I get it from? That is if it's not under operating activities and under investing, where you have sold maybe a car and where you have sold inventory. Okay, the other, or what we call financing, there are mainly two. You look at equity, or what you call the, yeah, it's equity basically. This is an equity. Then, for example, prefer saying you look at share capital. Okay. Yes, the share capital, but they also share premium. There is a evaluation reserve. All these are under.
My friend, Donna says just a person who's there in white. Those, you know, those glam friends that you happen to have on your Snapchat.
Guys, I'm recording this, so if you're going to be making noise like that, I'd rather have a few, then you guys will find these videos on what? On YouTube, that regard. Please respect yourself. Once you join, kindly mute. Yeah, pay attention to your phone until you mute, then you can do other things. Financing activities, you have, like I was saying, you have equity, share capital, reserves, whatever falls under equity. Okay, retained earnings, all these fall there. Then you have long-term debt. Okay, the exceptions given to financing lease. Because financing lease usually has also that current asset component, current liability component. Okay, so that's where the excuse comes in. But ideally, it's supposed to be long-term debt here. Okay, then and that's it. So once you have all these added together, they should give you the net cash flow. So changes in net cash flow. So depending on what it is, if it is a deficit, then it's a surplus. Okay, if a surplus, that means it's an increase in cash flows. Deficit, that means there's a decrease in cash flows to be negative. Okay, and that is it. Okay, so this change usually is the same, supposed to be similar to when you get cash flow, cash and cash equivalents at the beginning of the year, and then you look at cash and cash equivalents at the end of the year. The difference is supposed to be that change that we get from these activities. Okay, so that's the brief background on cash flows. As you look at your balance sheet, as you look at your profit or loss statement, you're just looking at items that fall under operating, investing, financing. Okay, so we start now. How cash flows? Of course, you know they have two methods. You have the direct method, the indirect method. Direct and indirect. Okay. The most set is indirect, because of the fact that indirect helps you to pull out the accounting that you know and the understanding. Whereas for the direct is it's more of a, they get you a receipt book, or if it's a receipt book, they get you a cash book. Yeah, which shows both receipts and payments. And then they tell you now to prepare cash flow. Yeah, of course, now from there, you'll be looking out for items that fall under income statement, and you see items that fall under the long-term assets that fall, I mean, money that falls under liabilities, share capital. Okay, because if you're looking at the cash book, I hope we're all familiar with the cash book. Basically, it shows receipt of money and payment of money. So if you want a receipt and you see something like cash from debtors, or you see cash sale, yeah. So those, you know, ideally should be falling under operating activities. Because by the way, I forgot something small under operating activities. We also have changes in working capital, changes working capital under operating activities. Here they look at current assets, current liabilities. Any changes in current assets and current liabilities, we put them under working capital, which is under operating activities. Okay, so still telling about the cash flow. If you see a receipt from maybe a sale of a car, yeah, so you just know that money we sold off a long-term asset, so it must be an investing activity. Okay, so that's direct method. Okay, so I prefer sticking to indirect, which is I think the most common set method. So how do you go about it? Indirect. Okay. The most important thing in cash flows is the line that you start with, which is under operating activities. We start with profit for interest and tax. Okay. Always, this is the first line. And whenever something given, you endeavor or you work hard to obtain it. Okay, that line. By adding back interest, adding back expenses, in case you don't have this figure. Okay, so I don't want to talk about it a lot. Then you do what you call adjustments. Okay, adjustments. These adjustments are mainly for non-adjustments, for non-cash flow. Cash flow items that were included in the income statement and therefore make part of the profit before interest and tax, and yet they're not supposed to be there. Okay, and that's where you have things like depreciation. Actually, let me just categorize. Say that we add all non-cash flow expenses. Whatever expense is in your profit or loss statement to come up with the profit before interest and tax, and so the cash flow, we add them back. Okay, so the same story. We less all incomes, less all non-cash flow. Cash flow incomes. Okay, and then finally, whatever you get is supposed to now deduct tax paid, then deduct interest paid. Usually it's interest coming first, so let me do that. Interest paid, then tax paid. Okay. So why we begin with profit before interest and tax is because of these two items that come later. Okay, that what you have in your income statement, usually it's not the interest or the tax charges that you actually paid. Okay, usually those are expenses that occurred during the year, yes, but you didn't actually pay them. What you paid as a cash flow, what you went to URA and paid, what they deducted in the bank may be different from what you're recording as your expense. So that's why we normally prefer, or that's why this statement always emphasizes that you begin with profit before interest and tax, so that then you show us that you paid this in interest, you pay this in tax. Okay. And then the others follow in line. You have investing activities. I won't talk much about them. Should just see us do the number. As long as it has to do with non-current asset, usually it's an investment activity. So if you're selling off any assets, you expect money. If you're buying any assets, you expect money to go out. Then financing. Maybe to emphasize here also, there's dividend received. Okay, that because investment activities, you may invest in, say, a company. You buy shares in a company. You have invested. It's long term, but they're paying you dividend. So if they pay you dividend, that's why it ends up being an investment. Dividend received. Then financing activity. Financing activity, there's nothing to think about it. Just know, as long as your equity items are changing, they're going to affect financing activities. Okay, if your long-term debt is changing, it's going to affect financing activities. So for debt and equity, you expect that if debt is reducing, yeah, if it's decreasing, you're saying it doesn't decrease by magic. Yeah, I think you're making a payment. So if you pay, then the debt will decrease. Okay, that's why we have always like repayment of debt as a deduction. And then capital. Okay, if you recover some capital, therefore you're paying off shareholders so that you return back your shares. Still, you're seeing shares are reducing, yes, all the share capital is reducing. And in that regard, you're saying you're going to pay off those guys to go away. Okay, so how about the increase? If your loan or debt is increasing, that can only mean that you're getting more and more of a loan, isn't it? Okay, so that's the whole point. Now let's look at the question, because this is basically what you look at. And maybe to emphasize the part of movement, the changes. It is supposed to get the cash and cash equivalents, okay, which usually are under current assets and current liabilities. When you go under these items, you always find there things like cash at hand, cash at bank, okay. You find there short-term investments, which are still under current assets. You find there maybe what bank overdraft, which is under current liabilities. Okay, so these are usually the main ones. Now, we say that you look at what you have at the beginning, then what you have at the end. That difference is supposed to be the movement, and that movement must be equal to these changes here, that the figures you end up having at the end. Okay, so let me see what someone is saying. Is interest paid the same as finance cost? Yes, whenever you see finance, it's not interest paid, but it is interest. Whenever you see finance costs, those are interest expenses. Okay, but they don't mean that it was paid. What was paid is when they say it was paid, or when you compete for it. Okay, as we're going to sample some of the questions. But what you take from here is finance costs are the same as interest costs or interest expenses. Okay, so let's look at this question. You're given this question and we're going to try it out. So once you see a question like this, usually give you 2 years because you want to see the movement. The profit or loss statement may be given, may not be given. But at least they will give you profit before interest and tax, or information that is enough to help you get profit before interest and tax. Okay, so this is what was given. Additional information. Then they say prepare a statement of cash flows for Dixon in accordance with I7 using indirect method. Okay. So since you all have a question, I may not refer to it, like I won't be sharing it again and again on the screen. Okay. So those are working. I'll try to use this very scratch or this very sketch to fill in it. So what's important is the heading. Okay, say Dixon's statement. Statement of cash flows is always for the year ended. It's like a profit or loss statement. Actually, someone asked me under FSA, if they tell you that the income statement is not a preferred measure of the performance of an entity or business, justify it. Yeah. So usually they want weaknesses of profit or loss statement, which we know from what we have seen under cash flows. Like I'll share a few. Okay, so in FSA, they emphasize the cash flow statement is actually far better. And when you think about it, really, I think it's far better. Because, for example, for the profit and loss statement, you know that sometimes they overstate revenues. And why they overstate them is because of the fact that they allow you to sell on credit, and they allow you to adjust for things like bad debts and things like that, estimates, okay, depreciation. Okay, so the income statement is easy to manipulate, okay, and therefore give false image. You're saying that you have revenues and sales of 20 million, but you may find like half of those are on credit. And you know, whenever you sell on credit, chances are high that all the chances that people will not pay you back. Okay, that's why you have bad debts and stuff. Now, when you talk of bad debts, then also someone may overstate the bad debts, okay, for some reason, or understate them, okay, depending on the agenda of management. They want to avoid taxes or they want to pay taxes. They want to avoid paying dividends to their shareholders, or they don't, or they are going to pay. So depending on what they want, may impact on how they manipulate these figures. Then things like depreciation. We know depreciation is not really an expense itself, okay, and therefore it's not the cash flow. To be specific, it's not the cash flow, and therefore it's not really supposed to affect or in any way make our decisions difficult or better. Okay, but the profit or loss statement, you know, you have to have depreciation. Okay, yeah, I've just talked about interest and expense and tax. Sorry, that the interests and taxes that we put in the P&L, if I may stick to taxes, usually these are provisional taxes. You know that at the end of the year is when you reach out to URA, and then URA will assess you based on what has occurred over the years. But you also know that you're supposed to pay taxes twice in a year. Have a provision. Okay, have a provision. Okay, not really pay, but file. You have to file provisions at least every 6 months. Okay, now where am I supposed to get that information for 6 months? So usually they use estimates, okay, as management or directors. Now, so the cash flow sticks on what you actually paid, what you incurred as an expense. Okay, so that's why it's a preferred measure or preferred statement if you're going to say we're doing well or we're doing badly, rather than the income statement. Okay, I've talked a lot on that, but kindly bear with me. Now, the heading statement of cash flows for the year ended. The year ended. This one ended when? Okay, it's important that you know those. This one ended 31st March. 31st March 2018. Okay, it's X8, but just bear with me, 2018. Okay, you can put what they want to avoid problems. X18, okay. Have the heading. You never know what could go wrong. Okay. Now we now start. Okay. So operating activities, we're saying look for profit before interest and tax. When you go to your question and we look for it, you find that under income statement. Okay, you find that you have revenue, gross profit, you have profit before tax. Okay, then you have profit for the year. There's nothing like profit before interest and tax. However, you look for something close to profit before interest and tax. So if you look at profit for the year, is it closer than profit before tax towards profit before interest and tax? I don't think so. I think profit before tax is closer to profit before interest and tax. That's the one you begin with. So you say profit before interest and tax. I may share my answer now. Okay, you're saying, let me start with profit before tax, and then I'll come slowly to profit before interest and tax. The figure that was given is 342. 340. Okay, so to it, we know that for me to get profit before interest and tax, I'm supposed to remove the tax, like I mean the interest. It's not supposed to be there. It shouldn't have occurred. What if I only have investment with no additional information? Investment, you just see where it's classified. If it is under non-current assets, then it's long-term investment. If it is under current assets, then it's short-term investment. At least for any question that talks about cash flows and has investment under current assets without additional information, usually it's a cash equivalent. Okay, it's assumed it's a short-term investment. That's why it's under current assets. Jack, I hope I've answered you. So I'm saying here, we add back the interest. Okay. Or in this case, we call it finance cost. Why we're adding them back is because we want to get profit before interest and tax. Otherwise, this figure here, the 342, already interest was deducted from it. I can just show you. Here, they're saying that for them to come up with this profit before tax, they had gross profit, they deducted other expenses, they even deducted interest costs to come up with the 342. So we're saying we want a position where we have just deducted other expenses before we deduct the interest cost. So that is when you say 514 minus 157 and you stop there. What you get is profit before interest and tax. But since we're starting from this side, we're saying you already removed interest costs. You put them back so that you have a figure without them. So that's why you add 15. I hope I'll make sense. So we say add 15 so that now officially you have profit before interest and tax of that. Okay, 354. Now, once you have this, you officially begun now your cash flows. So we shall go and use the workings that they give us in class. Where you start with the statement of financial position, you move line by line, as you refer to additional information to see if there's anything that affects our items. So we're saying workings. So we start with the non-current assets because they're the first in the balance sheet. Let me show you. Okay, saying after getting that, just come to your statement of financial position. Okay, then move from up to bottom, line by line, like that. Since we know where each falls, that anything that deals with non-current assets must go to what? To the investment activities. Anything that deals with current assets goes under operating activities, or at least cash and cash equivalents. Then anything that is under equity financing, like that. So let's start with PPE. PPE. So PPE, as you can see, it is increasing. But that's not our problem. Our problem is began with this. Things happened in the middle, and we expect at the end of it all to have 8 to 5. Okay, so when you go to your workings, you say, I want to start with PPE. Then start the opening balance. You can say opening balance or balance. Balance brought down. Okay. This one, of course, we're referring to 2017. Let me emphasize the previous year. 17 is the opening balance. The closing balance of the previous year is the opening balance of this year. The amount is 637. You can also call it the closing, but this time you leave space just for inactivities that may occur in between. You say closing balance or balance at the end of the year. Balance carried down but you know it's referring to 2018. The amount was 825. So now here, I will know, or I know that for the fact that if I add everything up here, I must get 825 at the end. Okay, so you go and look at any information regarding PPE that could increase the PPE balance or reduce it and include it here. Okay, so this is where there's a challenge because it may waste time. You have to go through. Actually, the easiest part to start with is the profit or loss statement to see was there anything like gain or loss or what or evaluation. Did we dispose of anything? Okay, so when you come to the P and L and look out for anything, okay, you find that we had a gain on revaluation of PPE of 100. So you know from our accounting that for this to occur, they must have debited PPE and then credited the income statement. Okay, or the revaluation gain. So having said that, you come here and you say gain revaluation. It increases our assets by 100. Okay, then after that, you now go to the additional information and see what are they saying about PPE. The first note is about goodwill and stuff, tangible assets. But then they say during the year, which you're looking at, PPE with the net book value of 300 were sold off. Now that's disposal. For disposal, we know that our assets cannot remain the same. They just reduce. So disposal of PPE items. Okay, what was the net book value? What we deduct from PPE is the net book value, the cost and the estimated depreciation that it had at the time of disposal. So what we remove. So they gave it to us as 103. It's a minus because we removed, it's reducing our assets. And then they said there was depreciation. We also know that depreciation affects PPE. That whenever I have a depreciation expense, you're going to debit depreciation account and credit accumulated depreciation. Okay, we know that from the CA lectures. Okay, computer accounting, or even from accounting 1. So therefore, you come here and you say, this is the accumulated depreciation I'm talking about. If you don't want to call it that, you can just call it depreciation for there. It is how much? It is 57, and still this one reduces our assets. You know that for the fact. Okay, but we also know that this depreciation is a non-cash flow item. So we know that for sure it was included in our profit or loss. So we come and adjust for it. It falls under non-cash flow expenses. So you say depreciation for the year. 57 was an expense, so you put it here, add it back, and you're good to go. Okay, so then you look for more items regarding PPE. They say that PPE purchased, Dixon purchased PPE of 56, but it was on financing lease. So financing lease, if you acquire assets on financing lease, you're supposed to capitalize the asset because of the fact that we have what you call substance over form concept in accounting, which emphasizes that as long as you have all the risks and rewards of the asset, without your land title, you actually own the asset. Okay, so having said that, we come to our PPE and show that we acquired, okay, finance lease. Okay, acquisition. Okay, this link is going to close shortly, so you can join in a few. Share code, the answer screen, please. Am I not showing this answer screen? Okay. Sorry about that. Okay, so the link closes in a few. You can join again in the same link. We'll continue. Okay, was 56. This one it came in, you have a new position. So let's join again in the other link, or in the new link, sorry, the same link, so that you continue.